Hello everyone, welcome to our new video. In this video we will start to talk about chapter 3, where we mainly cover financial statements. So let's get started. First we introduce a few terms or concepts. Annual report. Companies issue annual reports annually to their stockholders and to many other investors. So the annual report contains basic financial statements as well as management's analysis of the firm about the past operations and potential future prospects. This is an important public information or statement that is useful for all the investors because we can check the annual reports and see how the company is doing in the recent 1 year and compare also this with the previous annual reports that the company announced. And this also gives us some idea about the future plans of the company. And then we have some financial statements that are very useful for investors and stockholders. The first one is the balance sheet. The balance sheet shows what assets the company owns and who has claims on those assets as of a given date. For example, typically end of the year, like December, let's say 31st, on a given year, the company reports the balance sheet and we can see what the company owns as the assets and what are the claims on these assets, as we call them as the liabilities. This will give us asset and liability situation of the company, and the difference between the assets and the liabilities will be the so-called equity. We will show that with some example. And then there is the income statement. Income statement shows us the sales, cost, and profits of the company during a given reporting period. And this allows us to see how the company is doing in terms of generating revenue. And we see what's happening with the costs. And we can also again compare this with the previous reporting periods and see if the company's revenues are increasing, decreasing, or what's happening with the cost. And finally, the profit numbers we can also observe. Then we have the statement of cash flow. This one shows how much cash the firm began the year with and how much cash it ended up with and what it did to increase or decrease its cash. Maybe the company, the operating cost has increased, so it has less cash, or maybe it has liquidated some of its assets, so it has more cash. So we will see the cash flow of the company in this statement. And then there is the statement of stockholders' equity, which shows the amount of equity the stockholders had at the start of the year, the items that increased or decreased equity, and equity at the end of the year. We can see within this statement. There are various global accounting standards that are used around the world, and in 2005, actually European Union required the adoption of so-called International Financial Reporting Standards, known as IFRS. And in 2007, the US Securities Exchange Commission, SEC, eliminated the requirement for companies reporting under IFRS to reconcile their financial statements to US generally accepted accounting principles. In the US market, this has been widely used, GAAP, And also in some emerging countries, they also use the GAAP, I mean the so-called GAAP. This is based on the US generally accepted accounting principles. But different countries might have their some slight differences in their standards utilized. But the main chunk here is based on the European Union and the US GAAP standards. These has been the most commonly used accounting standards. But in our course, we are not getting into the details about accounting standards. We are mainly interested in understanding the financial statements and making investment decisions using these statements. The stockholders' equity, this represents the amount that stockholders paid the company when shares were purchased and the amount of earnings the company has retained since its origination. And then, as you see, the retained earnings, this is a cumulative total of all earnings kept by the company during its life. So this figure is very explanatory to see the bigger picture and what we are talking about in a balance sheet. So this is for the balance sheet. That's the first financial statement we are looking at. And on a balance sheet, we have assets and liabilities as two columns. We can separate them. On the left side, we will have the assets. On the right-hand side, we will have the liabilities and the stockholders' equity. This is the stockholders' equity item. So we have these three main items on a balance sheet, okay, overall. Just think about the total asset as one big item, and then you have total liabilities that contains all the liabilities as the second major item, and then the remaining is the equity, stockholders' equity. So we have these three major items. And within the assets and liabilities, we have subcategories. For example, on the left side, this starts from the most liquid, and as we go down, the least liquid assets are listed. So from the most liquid to the least liquid assets are listed in the balance sheet. Similarly, on the liabilities, the most immediate claims are given at the top, and the longer term and the least immediate claims are at the bottom of this list. Okay, and within the assets we have so-called current assets that are, very liquid, more liquid assets, including the first item. The most liquid is the cash, of course, and equivalent to cash items. And then we have accounts receivable as a second, you can think as a second liquid asset. And then we continue with inventory, and we have more longer term fixed assets. Okay, fixed assets are not that liquid because it takes some time to be able to sell them. For example, the building, equipment, or the land, etc., that the company owns. These are fixed assets, but they are not very liquid. And then all these items are added together under the total assets. The liabilities side, we have the accrued wages and taxes. These are quite immediate payments, like every month the company needs to pay the wages. So these are very short-term claims. And then we have accounts payable, notes payable, again short-term claims. And on the another major subcategory for the liabilities is the long-term debt. This contains maybe long-term credit or other obligations of the company, but usually they are longer term than more than 1 year time to pay these liabilities. And then we have the stockholders' equity that contains the common stock, retained earnings, and this is when we add them together, this must be equal to the difference between total assets and total liabilities. So always the left and right hand side of the balance sheet must be equal to each other. Okay, that's a accounting identity. So it is always going to be identical. The left and right columns, the total assets versus total liabilities plus equity is always identical. Stockholders' equity, we can think of this in two ways. First, this is the amount the stockholders paid to the company when they bought shares the company sold to raise the capital, like IPO, for example. In addition to all of the earnings the company has retained over the years. So the stockholders' equity is written as paid in capital plus retained earnings. And remember, the retained earnings are not just the earnings retained from the given year, but this is cumulative total. All of the earnings the company has retained during its life. Therefore, when we consider the stockholders' equity, this is going to be the difference between the total assets minus total liabilities. And as we already explained, this is an accounting identity. Assets on the balance sheet are listed by the length of time before they will be converted to cash. As I explained a little bit already, inventories and accounts receivable, and then we have the fixed assets. So we go in the order of most liquid to the least liquid assets when we write the left side, because on the balance sheet, right, we have the assets on the left side. So starting from the most liquid item, 1, 2, 3, we go to the least liquid item on the asset side. And similarly on the liability side also, we start from the most immediate claims and go towards the longer term claims on our assets. So similarly, the same logic, claims are listed in the order which they must be paid. Accounts payable usually must be paid within few days time. Accruals again also very short term. Then you continue with listing longer and longer term claims on your assets. And of course, at the bottom of the liability side, we have the equity, which actually never need to be paid off, right? That's the capital. We don't need to pay it to the equity owners. So here's an example of a balance sheet for the company's so-called allieds. And we can see also comparatively from year to year. So suppose this is given before for 2013 and then we are looking to 2014 at the same time. And on the asset side, as you see, you have the current assets that are highly liquid. Starting from the most liquid, we have cash and cash equivalents. And actually you can see it decreased from 80 million. So this is in the unit is millions of dollars. So this is 80 million. This is $10 million. So we can notice a decrease in the cash and equivalents for this company. And then the accounts receivable actually increased slightly. And then you can see also a strong increase in the inventories of the company. So adding these together, the total current assets is obtained. So the total current assets, adding these, we get this is one basically billion, okay, $1 billion. by adding the units appropriately. And then we can see there's a significant increase from $810 million to $1 billion in terms of the total current assets. And then the less liquid assets are written. That's the fixed assets, including maybe this corporation has some plant and equipment. So we write these minus depreciation, because again, according to the accounting standards, we apply various depreciation schemes to equipment or plant or other fixed assets. For example, if you have a computer as the company, this computer is also a fixed asset, and maybe it has the life of expected life that you can use this computer is 10 years, just as an example, hypothetical, okay? So every year you will reduce 1/10 10% of the value of the computer will be deducted, because after 10 years this computer is useless, right? That's the lifespan we can use it. So we can deduct 10% of the value every year as a depreciation, okay? So that's how we evaluate the fixed assets. And for different fixed assets, different lifespan and different depreciation rate can apply. Okay, like for the automobiles of the company might have a different depreciation scale, etc. Those details, I mean, we are not really getting into those details. It's not necessary, but we should understand that's the logic behind this. And then, as you see, there's also some increase in the net plant and equipment, net fixed assets, and then we have other assets expected to last more than a year. That's given as 0. So the total now, we need to write the total assets that is calculated here, 1,000 and another 1,000 for the current assets. So by adding these together, we obtain 2,000. So we add these together. This increased from 1,600 to 2,000. So the total assets has increased. On the liability, that's the right-hand side of the balance sheet. Again, we can see what's happening with the claims on our assets. Again, current liabilities, these are immediate, the short-term claims we need to pay soon. So accounts payable, like suppose this is 60, it increased, it doubled from 30. Accruals is similar level, and then notes payable. And then once you list all the current liabilities, you add them together and obtain the total current liabilities. Okay, again, this was from last year. This was the total current liabilities. So current liabilities increased, from last year. And then you have long-term, for example, bonds. Bond is a long-term liability. Okay, I mean, not necessarily every company must have this. Some companies, maybe they don't issue the bond, okay, so they will not have this item, but they might have another long-term credit, for example. So this is just an example balance sheet, okay? There are various items we can encounter in the list of liabilities. But typically, many, we are talking about publicly traded corporations and their balance sheet in this course. So we might often have long-term bonds that is also listed as part of the liabilities. And then the total, you sum the total current liabilities, total long-term liabilities, all together, we calculate the total liabilities of this company. And then we have the common stock and retained earnings. Okay, on the equity side, we have the common stock. Okay, we have the total value of this initial paid-in capital is $130 million. And as you see, this remains the same over time, okay? Because it is already paid when the company issued the stock. It is paid for 50 million shares is issued in, let's say, in the IPO, and basically we received this 130 million as the capital. So it remains the same. It doesn't change over time. But anything the company earns over time is added in the retained earnings, and that is a cumulative number. So as long as the company is profitable and generating profit and retaining those earnings, then it will continue to add on this common equity part. Okay, so the total common equity will be the sum of these two items, given as $940 million. And once we now calculate the total liabilities and total equity, we will add these together. So these two numbers added together, that gives us $2 billion. Okay, and notice that this amount is same as the total assets that we see here. As we already mentioned, this is an accounting identity, and it will always, the left side and right hand side of the balance sheet always must match. Okay, so let's stop here, and then in the next part we can continue from here. Thank you.